Escalation of the U.S.-China trade war, a global economic shift. The ongoing trade war between the United States and China has escalated into a full-scale economic conflict.
And China also had an additional 10, so it's 10 plus 10.
If Trump is imposing tariffs, we're ready.
Over intellectual property theft, unfair trade practices, and industrial subsidies. These tariffs, which started at moderate levels, quickly increased, with some reaching as high as 25% on select imports. The goal was to pressure China into changing its economic policies, particularly in areas where the Chinese government supports domestic industries through state-backed subsidies. However, China swiftly retaliated by imposing its own tariffs and tightening export controls on rare earth metals, essential components in industries such as electronics, defense, and electric vehicles. Since China dominates the supply of these critical materials, its decision sent shockwaves through global markets. American manufacturers, particularly in the semiconductor and automotive industries, faced rising production costs and uncertainties in securing alternative sources. The disruption of global supply chains. The U.S.-China trade war has significantly disrupted global supply chains, forcing businesses to adapt to higher tariffs, export restrictions, and increasing production costs. Many industries, including manufacturing, technology, and automotive, have long depended on affordable raw materials and components from China. The sudden shift in trade policies has created shortages, raised expenses, and forced companies to make tough decisions, absorb the financial burden, pass costs on to consumers, or relocate production to other countries. China's dominance in the rare earth metals market has placed industries that rely on these materials, such as smartphone, electric vehicle, and military equipment manufacturing, at a disadvantage. While countries like Australia and Canada have reserves of these elements, mining and refining them is expensive and time-consuming, making it difficult to replace China's role in the global market quickly. As businesses attempt to reduce reliance on China, many have moved production to India, Vietnam, and Mexico. However, shifting supply chains is neither easy nor cheap. Establishing new factories, training workers, and setting up logistics require significant time and investment. In addition, these new production hubs face higher costs and infrastructure challenges, which add to the instability in global trade. Impact on consumers. As businesses struggle with rising costs, consumers are feeling the impact through higher prices on everyday goods, including household items, electronics, automobiles, and even groceries. The inflationary effect of tariffs is particularly concerning for lower-income households, which are more vulnerable to rising costs and may need to cut back on essential spending. Supply chain disruptions have also led to product shortages, making certain goods harder to find. Industries relying on Chinese suppliers for key materials, such as automotive, technology, and consumer goods, are experiencing production slowdowns. Consumers looking to buy cars, smartphones, or laptops face longer wait times and fewer options. The automotive industry has been among the hardest hit. Rising production costs due to tariffs on imported vehicle components have forced major manufacturers like Ford, GM, and Stellantis to either absorb the higher costs or pass them on to consumers. This has led to a sharp increase in new car prices, with fewer discounts and incentives available. Additionally, the semiconductor shortage, worsened by tariffs, has delayed new car production, further limiting availability and driving up prices in the used car market. Beyond automobiles, essential goods such as medical supplies, electronics, and home appliances have also become more expensive or scarce. The medical sector has been particularly affected due to tariffs on Chinese-made syringes, needles, and protective equipment, which have driven up healthcare costs. Meanwhile, China's reduction in oil import from the U.S. has created fluctuations in fuel prices, adding another layer of uncertainty to the economy. Stock market and investor uncertainty. The trade war has created significant volatility in global financial markets. Investors closely monitor every new tariff announcement and policy shift, causing stock prices to fluctuate dramatically. Businesses struggling with higher costs and disrupted supply chains face declining profit margins, leading to market uncertainty. One of the biggest concerns for investors is the impact of tariffs on corporate earnings and overall economic growth. Many multinational corporations, especially in the technology, automotive, and manufacturing sectors, rely on Chinese suppliers and markets for a significant portion of their revenue. However, With rising tariffs and shifting trade alliances, these companies are experiencing increased costs, slower production, and shrinking profit margins. The semiconductor industry, a cornerstone of modern technology, has been particularly affected. As production costs spiral and supply chain disruptions continue, investors are increasingly concerned about the sector's long-term profitability. Additionally, China's growing economic ties with Russia and Middle Eastern nations are influencing global trade and investment strategies, adding another layer of complexity to market predictions. Some analysts warn that if the trade war continues, it could trigger prolonged market turbulence and economic stagnation. While governments push for domestic manufacturing and self-sufficiency, dismantling global supply chains is an expensive and time-consuming process. Until sustainable alternatives are established, financial markets are likely to remain volatile, making investment strategies increasingly challenging. Retaliation in China's economic strategies. China has responded to U.S.-imposed tariffs with countermeasures designed to protect its economy while putting pressure on American industries. One of the most significant moves has been restricting exports of critical materials needed for technology manufacturing and renewable energy development. By limiting access to rare earth metals, essential for semiconductors, electric vehicle batteries, and military equipment, China has forced U.S. and European manufacturers to scramble for alternative sources, leading to higher costs and potential innovation delays. Beyond resource restrictions, China has shifted its focus towards strengthening economic alliances outside the U.S. It has increased trade with Russia and Middle Eastern nations, particularly in the energy sector, while reducing its reliance on American imports. Additionally, China is expanding its Belt and Road Initiative (BRI) to secure alternative supply chains and international markets. China is also investing heavily in technological self-sufficiency. The U.S. tariffs on semiconductors and electronic components have accelerated China's efforts to develop its domestic chip industry. The Chinese government has funneled resources into artificial intelligence, quantum computing, and battery technology to reduce dependence on American tech firms and establish itself as a leader in advanced innovation. However, China is not immune to the economic consequences of the trade war. A slowdown in exports, declining foreign investment, and shifting global supply chains have created new challenges for Chinese businesses. Some multinational corporations are relocating their production to Vietnam, India, and other emerging economies, reducing China's dominance in manufacturing. Rising costs and supply chain inefficiencies are further straining Chinese industries, especially those relying on overseas markets. A global domino effect. The U.S.-China trade war has forced other major economies to reassess their trade policies and supply chain dependencies. Many nations are imposing their own tariffs, strengthening domestic industries, or seeking alternative trade partners to reduce their reliance on both the U.S. and China. This shift is reshaping global trade alliances and accelerating the push for regional economic self-sufficiency. Countries like India, Vietnam, and Mexico have emerged as new manufacturing hubs as businesses relocate production to avoid trade restrictions. However, transitioning supply chains is a costly and time-consuming process, leading to short-term inefficiencies and production delays. The European Union has also taken action, imposing tariffs on Chinese electric cars while investing in domestic battery and semiconductor production to reduce reliance on Chinese imports. While these shifts may create stronger and more resilient supply chains in the long run, the immediate effects have been economic instability and rising costs worldwide. Smaller economies that depend on trade with the U.S. and China are particularly vulnerable, facing uncertainty from changing policies that impact businesses and investments. The push for domestic production and self-sufficiency. The trade war has accelerated efforts by the U.S., the EU, and Asian economies to prioritize domestic production and economic self-sufficiency. Governments are offering subsidies and incentives to boost local manufacturing, reduce reliance on foreign supply chains, and strengthen key industries. However, reshoring production is a complex and expensive process. Industries that have spent decades optimizing global supply chains for efficiency now face higher labor costs and increased production expenses. While this shift may eventually strengthen local industries, it requires substantial investments in infrastructure, workforce development, and supply chain restructuring. The long-term question remains: will this transformation create a more stable and resilient global economy, or will it lead to prolonged instability and higher costs? As the trade war continues to evolve, businesses, governments, and consumers worldwide must navigate an increasingly uncertain economic landscape.